We can't really get away from it, right? It's the U.S. elections, right? Overhanging markets right now. The race has gotten tighter. According to some polls, Harris is actually ahead. This is Reuters Ipsos by about 2 points. Who knows what could happen within the next 100 days? But I mean, it's binary. It's either a blue White House stays blue or it turns red. What do you think is likely to happen?
Well, so I think we've got to bear in mind that we don't just have an election in November. We have over 30,000 elections in the States in November. And as we go down the ticket, as they say, as we look at Congress and so on, these are all going to matter a lot. And it makes quite a big difference to the potential policy stance. If you've got a Trump White House but with a Democrat House of Representatives, for example, or vice versa, or a Harris White House with a Republican Congress, this really does make a difference. Yeah. The other thing that I think markets are still struggling with, and I think this is something I come across a lot with clients, is the question of, is Trump serious with regards to the trade tariffs? Yeah. Because if he is, then there's a very, very different economic scenario.
But if we have a problem.
Yeah, but if this is just sort of posturing in order to negotiate a better trade deal or whatever, then it's a very, very different scenario. But a universal tariff, we haven't had one of those in the States since 1971. Yeah. Very, very serious economic implications.
To be clear, you're talking about 10% on anything that comes into the U.S., right?
Exactly. Yeah. So what happened, we all know, in Trump's first term, he goes with selective tariffs, not a universal tariff, selective tariffs primarily against China. And, of course, those are easier to avoid. You know, China sends the goods to Canada, you put a maple leaf on the side of the box,
and it's transported.
And they have. And not all of them, obviously, but they reroute the supply chains. There's a universal tariff, unless you're going back to smuggling, which the US was very good at before they so foolishly rebelled against the British, then it's going to be a problem.
Ultimately, regardless of who's in the White House, is inflation going to be out of the box again, and how could that change the Fed's calculus?
So the baseline, if we put to one side the tariff question, because obviously tariffs are a tax on US consumers. It's all very well saying it's a China tariff. It's not. It's a tax on US consumers.
Right.
So that will raise price levels. If we put that to one side, inflation is back to being benign. And I think we've got to reflect what's happened in the last 18 months, 2 years, in the US and elsewhere. We have had an absolutely astounding drop in inflation. 8-9 percentage point decline from the high without any noticeable increase in unemployment. And that, I think, really tells you just how peculiar, just how transitory the inflation was. If you get an 8-9 percentage point drop with no increase in unemployment, that's telling you this is not a normal inflation episode.
Can I push back on this issue over are we seeing material deterioration in the labour market or not? Because Bill Dudley is talking about the SARM rule, and he's saying, look, there is a non-negligible risk of recession. The Fed has to act now, and it has to act in July.
September will be too late, is his thinking.
That's right. Are you on board with that view?
So I think the Fed's too late. I don't think it triggers a recession. So the thing is, we've had falling inflation for a long time now. By doing nothing, the Fed is raising interest rates in real terms. So by doing nothing, the Fed's tightening policy. So when we talk about rate cuts, I think it's wrong to describe a Fed rate cut as an easing. It's not. A Fed rate cut is just sort of stabilising real interest rates. So I think the Fed is late. This is what happens when you have somebody who's not an economist running a central bank. So that's an issue, but it's not dire, because you know what? They're probably about 3 months late. 3 months is not disastrous. It's unnecessary pain, but I don't think it necessarily pushes you over into the brink.
But is there anything in the data, and I know it's a volatile data set, and when you look at the most recent jobless claims, 243,000, higher than expected, highest since August last year, does that smack of material deterioration in the labour market, and are we heading towards what could be a growth scare?
So I don't think we've got a material deterioration yet. So there are lots of problems with the data. Non-farm payrolls has become far less reliable as a statistic, all this sort of issue. But what we have still got, I think this is fairly clear, middle-income consumers are not afraid for their job security. And that, for me, is the breaking point. If the middle-income consumer, because that's what matters to the economy, if they suddenly start fearing the future, if they suddenly fear that they're going to lose their jobs in the future, then that's going to trigger a precautionary saving. People say, well, I'm worried about the future. We're not going to go and buy a fourth sports utility vehicle. We're not going to go and buy another television. We may have to think about how many Taylor Swift concerts we go to this year. That then becomes the problem. I know you're a massive Swiftie, Sri.
We are, aren't we? Yeah. So listen, even if the Fed is, let's say, 3 months too late, it's not too terrible, right? Let's say they cut in September, right? November, Trump comes in. 10% across the board, anything that comes into the U.S., can the economy handle it? Can the U.S. economy handle that?
So that's a lot more serious, I think. Now, we've got to remember that this, as a sales tax, it's a one-off price increase. That's the first point. The second point, I think, which is very important to remember, a lot of people say, well, 10% tariff means prices go up by 10%. That's not true. Tariff is applied to goods at the port. And the price of a good at the port is about 40% of the price of a good in the store. Because in between that, you've got wholesale and retail and transport and advertising, all this stuff. Yeah. So we need to take a breath and consider that. But unquestionably, there is no way you can spin a tariff, a tax on US consumers, as being positive for US consumers. Of course it's not.
As Trump has been trying to do, right? We'll make China pay for this. No, the US consumer is going to pay for this.
Absolutely, because it is a tax on the consumer. And if it's a universal tariff, it's a tax on consumers of pretty much everything, so that's going to be an issue. So that would be the damaging side. Whether it's inflationary, of course, because what you've got is a negative shock to growth, because the consumer's suffering under this, and you've got that one-off increase in prices. So it's a far more complicated picture as to what it does to price levels after the first year. First year is very clear.
And shock is the instrumental word here. Paul, do you feel that there are supply-side shocks waiting in the wings because of the geopolitics, whether it's Ukraine, whether it's Taiwan, whether it's the Middle East, and supply chain challenges?
So I think we're shifting here, and we're shifting in two ways. So firstly, within the existing structure of global trade, we are seeing, for example, more inventory being held than has been the case in the past. So there are some adjustments that are coming through there that doesn't prevent there being a supply chain shock, but perhaps softens the blow.
This is just in case inventory management, not just in time.
Exactly. Right, exactly. And we're not going back to the inventory of 20 years ago, but there's more being held. And then the second thing, I think, is that we are changing supply chain structures. And this was always going to happen. There's this process of localization that you have digitization, you have automation, you have robotics. And that means that the complex supply chains that we've got are becoming simpler, and more stuff can be made locally without using so much labour. Use capital for labour substitution, if you'll forgive an economist descending into jargon. But that's essentially what we're talking about here, that you put in place a robot rather than 500 people in Shenzhen, then you're going to be able to localise production. And if we look at the entertainment sector, we look at things like fast fashion, this is already starting to take place.
So would it be fair to say that, right, November outcome, even if it is, if the White House turns red, right, as long as Congress stays divided, split government, gridlock, markets are going to be okay with that?
I think they will be generally okay. I mean, that sort of mitigates some of the excesses. Of course, what we have to remember is that a lot of the trade policy comes under the President's Commander-in-Chief power. It doesn't need Congress for that. It wouldn't be that you get tariffs on day one, because there is a process which has to be followed, but the President can do that sort of unilaterally. But when we're looking at other aspects of fiscal policy and so on, there would have to be some kind of consensus, and that mitigates things.
So let me ask you, if it is Trump, right, and if it's going to be ruled by executive order, as you say, right, and it's going to get back to tariffs, especially if Bob Lighthizer gets back into the saddle as well, right, what happens to the industrial policy of Joe Biden, which has been about, de-risking, making supply chains more resilient, et cetera? Does that go out the door?
So I think that, effectively tariffs start to do that, because tariffs provide quite a lot of damage to US companies. Because let's remember, up to 2/3 of global trade is inside the company. You're sitting here talking to a British export. But this is UBS exporting me to Singapore to work with my colleagues here in Singapore for the next few days. So what we've got here is an internal decision. Yes, I'm an export, but I'm being exported from UBS London to UBS Singapore. I'm very happy that they have exported me. But that's what goes on with a lot of global trade now. With these complex supply chains, it's internal to companies. So you start putting in place tariffs. The challenge is very often to companies that have been using global subsidiaries to supply themselves, and that's why it dramatically changes any kind of industrial policy that you've got.
Okay.